Hi guys, just a quick update from here. I'm doing good and I'm going towards my goal. And I've been reading this book. I've been reading this book called The Contrarian Investors 13. And this book is about So I've been reading this book called The Contrarian Investors 13 by Benj Gallender. And he has had some really good returns. For example, almost 65% in 2001 and 43% in 2002. And I've been going through some of the chapters, and I guess some of the important stuff in this book, as far as his investment strategy, is when he does a screening for stocks, he uses the 10-year rule. Now, the 10-year rule is about only looking at companies that has been on the stock market or the stock exchange for at least 10 years. So the company is has a track record, and that the company is well established in terms of having been exposed to the stock market for an extended period of time, being 10 years. Now, another rule that he goes by is the 30% rule, or the 50% rule as he call it. And that means he's screening for stocks that are 33% down over 1 year, meaning that the stock has fallen a minimum of 33% during 1 year, and which indicates the upside of 50%. That going from a fall on 33%, going up to where it was before, will increase the stock value with 50%, and therefore the rule of 50%. And lastly, I think one of the most important things that he uses in his strategy is to buy so-called cheap stocks. And the way he defines it is that he looks at stocks that are below $25 per share, and I would argue that you can argue that this is you can still find stocks that are expensive, going on a below $25 per share. For example, if you measure it on the PE, but his thesis is that if the stock price is below 25, it will have a better likelihood of gaining more value in dollar terms per share than a stock price that is above 25. And apparently this rule has some merit, because he has used this strategy with great success. The thing that I'm thinking about also in terms of this strategy, he does show some numbers on companies that he has bought into and where he has made some good gains over less than a 9-year period. The thing that strikes me the most about this is probably that he's talking about companies that are, in this case, in these two examples in his book, on page 101 and going to 103, almost beaten down stocks, I would say, because they certainly have been they certainly have been falling a lot in terms of the stock price, and so the thing that strikes me is that he's looking for turnarounds, and if I remember correctly, Warren Buffett says most companies do not turn around. So the thing that I'm questioning here about this strategy is how difficult is it really to find a stock and a company that has the ability to turn the business around and to gain momentum. Now, recently I've been looking into some stocks of my own. I was looking into AMD, Advanced Micro Devices, the chip maker, the graphic cards maker, and so on, when it was about, I think it was around $2 per share, and now it's almost in 28, I believe, $28 per share. And I was thinking about buying it at a certain point in time, but I was going through the fundamentals of the company and thinking about, well, how bad can it continue to go before this company goes bankrupt? And I think that's a question that one might need to ask oneself when looking into companies. Certainly in this book, he also talks about it, that there is a chance that a company might go bankrupt. So I think that's the tricky thing, and that's the difficult thing when you look for turnaround companies. You probably want to have some cushion of some sort, and you want to have a company with a somewhat good balance sheet, so you can avoid losing all your money potentially if the company goes bankrupt and they don't have enough assets to cover the downfall of the company. Otherwise, I was thinking about, as I read this book, which is a quite good book, doing a mock-up portfolio and trying to do some screening myself, following these rules. Maybe make a portfolio consisting of 5 to 10 companies that really has the potential to turn around, and also have some good balance sheets, and companies that still have some good brand value and preferably a good moat, and maybe you could argue that AMD would be a candidate for this, at least before it skyrocketed. Should probably have bought some stock before that happened, but I wouldn't be surprised if there are more candidates out there, and I would really like to hear if you have some suggestions on and comments about the strategy just outlined here in the Contrarian Investor 13 buy bench calendar. So see ya.